All right, let's jump right into it. Today, we're tearing down the engine of what is absolutely the most crucial, yet kind of misunderstood financial machine on the planet, the U.S. Treasury market. It's so easy to just think, oh, it's just how the government pays its bills. But no, it's way more fascinating than that. This market is literally the plumbing of global finance. It's totally invisible to our daily lives, but it pumps the liquidity that keeps the whole global economy moving. By the end of this explainer, you're going to understand exactly how this massive system actually works, from the second a bond is born to why it absolutely dictates the financial weather for the rest of the world.
Okay, so here's our roadmap for today. We'll start with the global risk-free benchmark, then move down to the spectrum of securities. After that, we'll get into primary dealers and auctions, followed by the secondary repo engine, and finally, we'll wrap up by looking at some modern strains and fragilities. Section 1, the global risk-free benchmark.
Right, before we get into the nitty-gritty of how government debt is actually sold, we really got to pause and just wrap our heads around the sheer mind-boggling scale of this thing. $27 trillion. That is the total value of the U.S. Treasury market. We are talking about the single largest, most liquid sovereign debt market on Earth. To put that insane number into perspective, it's basically the entire economic output of the United States in a single year, or the combined GDPs of China, Japan, and Germany. Because it's just so massive, and because you can buy and sell these securities in a heartbeat, it serves a function that goes way beyond simply funding government deficits.
You'll often hear U.S. Treasuries called the risk-free benchmark asset. But what does that actually mean for you and me? Well, it means this is the bedrock of global finance. If you go out to get a mortgage, or a corporation borrows money for a new factory, or your city builds a bridge, the baseline interest rate for literally all of those things is anchored right here to U.S. Treasuries. But it's even bigger than that. Foreign central banks hold these as their main foreign exchange reserves. Huge global institutions hold them as high-quality liquid assets, basically bulletproof collateral. The entire world relies on this one specific asset to balance the books. Section 2. The spectrum of securities.
So, what exactly is the Treasury selling to manage its cash flow and interest rate exposure? Well, let's walk through the menu of debt instruments they issue. Starting at the top, you've got Treasury bills or T-bills. These are short-term, maturing anywhere from 4 to 52 weeks. They're kind of unique because they don't pay a regular interest coupon. Instead, you just buy them at a discount. So you might buy a T-bill for $95 today, and the government just hands you $100 when it matures in a few months. Then we have Treasury notes. These mature in 2 to 10 years and pay a fixed coupon twice a year. The 10-year T-note is actually the ultimate benchmark for global finance. For the really long haul, we've got Treasury bonds, maturing in 20 or 30 years, which are super sensitive to long-term inflation. And finally, TIPS, Treasury inflation-protected securities. With these, the actual principal adjusts with the Consumer Price Index, which is a really neat way to protect your purchasing power.
Section 3. Primary dealers and auctions.
Okay, now that we know what they're selling, how do these things actually get created and pushed out into the wild? We have to clearly separate the two arenas where treasuries live. Think of the primary market as the birthplace. That's where brand new debt is sold directly by the government via auctions run by the New York Fed. Once that debt is born, it graduates into the secondary market. This is where existing treasuries trade over the counter, meaning, directly between two parties without some centralized exchange, 24/7 among global banks, central banks, and hedge funds. It's super important to grasp this difference before we look at how the primary auctions work. Now, what's really wild is the incredible responsibility placed on a tiny group called the primary dealers. We're talking about an exclusive club of roughly 24 elite financial players, names like JP Morgan Chase and Goldman Sachs. They aren't just invited to participate in these primary auctions, they are legally obligated to bid in every single one. It is basically the world's ultimate mandatory shopping spree. Why do this? Because it creates an absolute essential firewall. By legally forcing these massive banks to bid, the system ensures the federal government never, ever defaults on an auction sale. No matter what crazy stuff is happening in the world, the Treasury will always be able to sell its debt.
Let's break down how those auctions actually play out. The New York Fed uses a Dutch auction format. Step 1, those elite primary dealers submit their competitive bids. Step 2, the Treasury starts filling the bids sequentially, starting with whoever is willing to accept the lowest yield, which is essentially the cheapest borrowing cost for the government. And they keep moving up until the entire offering amount is met. And here's step 3, which is frankly brilliant. All the accepted bidders, even the ones who asked for a lower yield, end up getting paid the exact same yield. They call that the stop-out rate. So the really cool thing here is that it totally levels the playing field for the winning bidders and ensures fair pricing for everyone.
Section 4. The
the secondary repo engine.
So once a treasury is out in the world, it usually finds itself in the repo market. A repurchase agreement, or repo, is this unbelievably vast, multi-trillion-dollar over-the-counter market. Here, financial institutions use their treasuries as high-quality collateral to secure cash loans, usually just overnight. It's basically, hey, I'll sell you this treasury today and buy it back tomorrow for a tiny bit more. This is the literal plumbing system for global liquidity. It's the lifeblood that keeps major financial institutions funded and operating day to day. Honestly, without the repo market, global finance would just grind to a halt. This is quite literally why your local ATM actually has cash in it when you need it.
Section 5. Modern strains and fragilities. Now, as brilliantly designed as this system is, things are getting a bit tense. We really need to take a serious look at the macro pressures that are currently threatening to crack this foundation. We started off talking about a $27 trillion treasury market, right? But we got to contrast that with this stark figure. The total U.S. national debt has now crossed $34 trillion. The gap there involves different types of intragovernmental debt, but the big takeaway remains the same. The Treasury has to continuously auction off historically unprecedented amounts of new debt just to keep up. That unrelenting sheer volume of supply that the market has to absorb is a massive source of strain today.
Let's break down these structural pressures impartially. First, as we just saw with that $34 trillion figure, massive debt expansion means we need sustained, unrelenting demand from buyers at home and abroad to absorb it all. But that leads to the second point, de-dollarization and shifting foreign demand. Historically, Japan and China were the biggest buyers, but they've been slowing their purchases relative to the new supply. So domestic banks and money market funds are being forced to pick up a lot of the slack. And third, we saw real cracks form in March 2020. When the pandemic hit, a sudden global dash for cash actually froze secondary trading. The plumbing got totally clogged, and the Fed had to jump in aggressively as the buyer of last resort just to keep the market functioning.
All of this points to a really profound macro reality. The Treasury market isn't just some financial tool. It's the ultimate empire constraint. Yes, it's the pillar of American economic power, but it's a two-way street. It also has the power to ruthlessly enforce fiscal discipline. There's a quote that hits the nail on the head here. The U.S. Treasury market is the pillar of American economic hegemony, the exorbitant privilege of issuing the world's reserve currency. That exorbitant privilege lets the U.S. finance massive deficits, sure, but only as long as the market implicitly trusts the structural backing and the ability to repay. The second that trust wavers, the market reacts.
Which leaves us with a pretty massive question to chew on as we wrap up. If sovereign deficits keep growing without structural backing, will market forces and rising yields eventually step in and enforce fiscal discipline on the American empire? Because if the supply of debt starts outpacing the world's desire to buy it, bond yields are inevitably going straight up. That makes national borrowing costs explode, forcing lawmakers to face the music whether they want to or not. It's a fascinating balance of immense power and immense vulnerability. Thanks so much for joining me for this explainer. I really hope it sheds some light on the incredible mechanics running just beneath the surface of the global economy. Keep asking questions, and I'll see you next time.